Welcome to the Bill Levinson Experience, a motivational podcast relating to the insurance brokerage industry and business in general. And now, here's Bill Levinson.
Okay, good afternoon, everyone. Welcome to the Bill Levinson Experience podcast. I am very, very excited about today's featured speaker, as always, as I am, in fact, every month. But this one is a little bit different. And the reason why I say different is Mary Read, who works for Pentegra, brings a sales strategy, a sales concept that every one of our agents, CPAs, estate planning attorneys, financial advisors, all of the above can walk away with a nugget of information that will help change your practice, okay? This is a different spin on tax savings, on retirement planning. It's a strategy that everyone can relate to, and you all should be going through your book of business, your database of friends, family, network, maybe any white-collar professionals that you know, especially right now during this whole COVID-19 pandemic, but start to put a list together of prospects that you can speak to about this strategy that we're going to discuss today. So make sure your pen and paper is out. You are taking plenty of notes, either on your app on the phone or your tablet or a piece of loose leaf paper, okay? It doesn't really matter, but the goal is that everyone gets their hands around this strategy and starts to make some new sales, okay, as soon as this afternoon, okay, depending on what time you're listening to this. So I want to jump right in here, and we're not going to take too much of your time, but I think right now during this crisis that the entire world is going through, we're all scratching our heads, trying to think of new ways to make sales, to reach out to prospects. And yes, you know, everyone is working on final expense and mortgage protection and indexed ULs for estate planning or ULs or whole life, whatever the case is, okay? But what this strategy is something that's a little unique, okay? And you can spin this as a wealth creation tool, a tax strategy, a way to reduce taxes, a legacy creator, okay? Peace of mind for your clients. Now, the way that we talk about this, and in fact, Mary Read, she's our guest speaker, but she's actually authored 3 books, and I'm going to share that at the end, but basically, without jumping ahead here, this is a great way to spin a marketing concept that basically says, hey, to your clients, this is your legacy on your own terms. Okay, we're going to talk about Life of the Southwest. We're going to talk about Lafayette Life, which Levinson has direct IMO contracts with both. Plus, they both come with our free scholarship program. So as you're listening to this presentation, remember that whoever you're speaking to, could be grandparents, parents, it could be single families, whatever the case is, okay? But remember, their child or grandchild gets a 1-year free tuition with any of these products that we're going over at no charge to the client, no commission reduction. So that's just another value add that you can speak about. Okay, so I would definitely write down that point. Both of these carriers come with the SAGE program at no charge to you. So great stuff to come. And again, this relates to everyone that's on the call and most of your clients and prospects. So I want to jump in again to our featured presenter, Mary Read, and I'm going to read her bio real quick. She has a very, very impressive bio and resume, and I picked out just a few parts that stood out to me. So Mary Read is a National Director of Pension and Protection Planning at Pentegra Retirement Services and partner of M&R Business Development Group, a leading authority in qualified retirement plans with more than 30 years' experience. Mary has an extensive background in plan design and development and experience as a marketing executive, financial professional, pension analyst, and pension compliance manager for an international company. Okay, so real quick, I want to also mention this. Before joining Pentegra, Mary was Vice President of Qualified Plan Marketing for a national life insurance company, otherwise known as LSW. Okay, so National Life supports career and independent producers in qualified plan sales and has been dedicated to writing qualified plan business for more than 65 years. Prior to joining National Life Group, Mary was a pension consultant with an actuarial consulting firm and previously was Assistant Vice President of Marketing and Retirement Planning for Money, a life insurance company of New York. She's a frequent speaker on qualified plans and a contributor to industry publications. Among her credits, she has taught pension classes across the country for major financial institutions and has been a featured speaker at national meetings for the Society of Financial Service Professionals. Okay? Very, very impressive. And folks, I skipped around. This wasn't even her entire bio. So we are so delighted to have her join us today. And I'm also going to point this out. We're doing something a little unique here today. If you get appointed with LSW or Lafayette with your first application, we're going to send you one of the 3 books that she also authored. So the 3 books, real quick, are My Business is My Main Asset, I Want to Retire Benefiting from a Plan, Stable, Secure, and How to Use the Tax Code to Get the IRS Out of Your Retirement. So we're going to include a link to her 3 books, and then again, get contracted with your first app. We will send you one of the 3 books. So first off, Mary, I really want to thank you for taking the time. I know how busy your schedule is, so we really, really appreciate you joining us today.
Oh, thank you for inviting me. I'm happy to be here.
Of course. So, I just want to tell everyone, how this whole presentation came up and how this topic even came up. So we work with LSW, National Life Group, for many, many years now. We had a webinar a few weeks ago, and Mary was one of the guest speakers, and she talked about this sales strategy and basically using the LSW IUL with living benefits as a way to provide for retirement, right, as we all know. And one of the agents that was on the call about 5 days later landed an IUL case with LSW at $179,000 of annualized target premium. Okay. And as soon as I saw that, I was like, oh my gosh, we have to have Mary on our podcast because obviously this concept works. She knows the game better than anyone I know, okay, when it comes to retirement planning and talking to business owners. And by the way, too, I'm also going to mention, if you are open and willing to work with her, okay, if you have the right case and obviously it's the right relationship, then we can definitely make the introduction. So Mary can help you on your next case, okay? And you guys can work that out, but you let us know. And if you're interested, she is available to you. Okay, so let's jump right in here. So, Mary, what I want to do, and the reason why we're all here today is we all want to hear about this distribution solution concept. So if we can dive right in, I want our agents to get comfortable with this concept so they can start presenting as soon as we're done today.
Okay, so let's start at the high level. First of all, looking at the market out there, I do qualified plans. As you said, I've done them for many years, most of that time with closely held businesses where they're really personal financial planning tools. And everybody loves putting the money in tax deductible and loves watching it grow tax deferred, and everybody hates paying the tax when it comes out. But it's not tax evasion. We're not going to jail. It's tax. We're trying to do tax advantage planning here to get that tax bill down. So we've now had IRAs since the 1970s. We've had 401k plans since 1981. And you overlay that with the baby boomer demographic. And what we have is we have a huge amount of money sitting in these qualified accounts. By stats, it's actually $32 trillion sitting in qualified accounts. Now, you think about that, and that money is moving, right? As baby boomers get older, We now have the Secure Act, which came into play as well, because the Secure Act was passed in December and took effect January 1. And what everybody talked about with the Secure Act was it pushed the required minimum distribution date from 70 and a half to age 72, right? Everybody was happy about that. Great, I don't have to take my RMDs until I'm 72. I personally didn't get too excited. I don't think 18 months makes all that much of a difference, but that was the big topic. But what was in that act also was they took away the stretch IRA. So think about all these people. Think about this $31 trillion. People have, it's not unusual to find accounts with 1 million, 10 million, 5 million, 7 million. We worked on somebody this past year had $24 million sitting in their IRA. Now that was a little unusual, but it's very common to find $1, $2, $3, $4, $5, $6 million sitting in these accounts. With this passage of the Secure Act, right, for someone who doesn't use up all that money in their lifetime and it passes to a beneficiary, usually ultimately it's going to go to children, spouses first, but then eventually probably to children. Before the Secure Act, that child, let's say a 30-year-old child inherited that account, they could then stretch that account over their lifetime, just taking the required minimum distributions, and you could watch that tax-deferred growth. You just see incredible numbers if you run some calculations. Well, who else is looking at that $31 trillion? IRS is. They want their tax revenue. So what they did was change that rule that when that account is inherited now, it has to be fully distributed within 10 years. So play that out in numbers. If you've got someone who's got, I don't know, let's say $1 million account, and it goes to their, let's say it's a 40-year-old child. Let's say we have, a 75-year-old dies, they have a 40-year-old child that goes to that child who's probably in their peak earning years. And now they've got $1 million that essentially is going to be dumped on them. They could take it out a little bit each year or let it grow, and then in year 10 they have to take it all out, and they suddenly get hit with this very high tax bill. You will see easily 40% of that money disappear. In some states, you'll see 60% of it disappear. Mm-hmm. That is a huge problem for people.
That's a huge problem.
Okay. So we have a solution to that. And the goal here is to get the tax bill down, and we can do that by structuring it correctly. We will also remove money from the RMDs. So for those people who have these accounts, they don't need the money. They hate the RMDs. One of the most hated sections of the tax code, I think. People hate the RMDs. We can get that money out of the reach of the RMDs and put it back in their control. And so now that person with that account can use that money when they want, how they want, and we can leverage up the benefit that will go to their beneficiaries, and that beneficiary will have control about when and how they want to use the money.
And what's mind-boggling to me is, Mary, if you can just explain to everyone what the difference in taxes would be roughly. If we're looking at your chart with a traditional IRA at age 90 compared to this distribution solution concept, just give them just a ballpark example of what the difference is on the tax bill.
Okay, so I'm going to give you the numbers from I have a standard 55-year-old example that I use, so I know
Perfect.
Those numbers. So okay. We'll use that. So we have a 55-year-old who has $1 million in their account. All right, so far so good. They have a statement, they bring it to you, they say I have $1 million. Except they don't really have $1 million because whenever they take the money out, the IRS is going to take their piece. So let's presume that money keeps growing. They keep it in that qualified account. I'm assuming that it grows at an annual compounding rate here of 4%. Now that may sound low, but let me tell you where that comes from. If you look over the S&P 500 for the last 20 years, the annual compounding rate actually is 6.01%. Most people have someone who manages their money. There's a fee for that. Typical fee is 1%, so I back 1% out of that. And then I'm assuming as people get older, they wouldn't have 100% of their money in the market. They'd probably have about 80%. That brings me to my 4% assumption, so just to explain where that came from. And I'm going to use maximum federal tax rate in my assumption, 37%, And I'm using a middle-of-the-road state tax rate here. It's about 5%. So with those parameters in mind, let's play out the numbers. So we've got this 55-year-old, they've got $1 million. We'll grow it at 4%. They get to age 72. They have to take the required minimum distribution. Have to. So they do that. And they do that for 18 years, and they pass away at age 90. If I add up the tax on all those required minimum distributions for 18 years, using current tax rates, the ones I just said, federal and state, not assuming tax rates go up, which is, probably going to happen, but just using current rates. So if I add up the tax on those RMDs for 18 years, plus the tax that will be due on the balance of the account at their death, the tax bill on that account becomes $1,355,000. All right. Now,
Unreal.
Keep in mind, right? Remember, they would never think that. Their statement says they have $1 million, and we're telling them your tax bill is going to be $1.3 million on this account by the time they're 90. But that is what it will be, and that again, not assuming tax rates go up. That's just using current rates. So $1,355,000. What else could they? So that's option one. They could leave it in the qualified account, let it grow, just take the required minimum distributions, pass on what's left to their beneficiary. Option number two, they could do a Roth conversion. So, and there are a lot of people out there recommending Roth conversions since the passage of the Secure Act with the loss of that stretch IRA. All right, so let's do a Roth conversion. So now I'm going to convert 5 years out to be fair here, because then we're going to look at the tax on the distribution solution strategy, and that tax will be in 5 years. So to use the same time horizon, I take my $1 million, I grow it at my 4%, I convert it in 5 years. My tax bill is $514,000. So a lot better. I went from $1,355,000 down to $514,000, right? And that will never be taxed again. Or we can do this strategy that we're talking about today, and the tax bill is $384,000.
Unreal.
So on your account, would you rather pay on this same account? Would you rather pay $1.3 million in taxes, $514,000 in taxes, or $384,000 in taxes?
That to me is the slam dunk right there. That's why I didn't mean to jump around, Mary, but I was looking at these numbers and I got excited about that, because I know that's a great door opener, just that within itself. So thank you for sharing that.
I mean, that is usually the first place it starts. That is absolutely the attention grabber. There's a CPA I've done quite a bit of business with out west, and he loves this concept and he uses it for his clients. I have a graphic representation of these numbers. Obviously, we can't see it on the WebEx, but when we do an illustration for a client, and it compares the tax over time, depending on what age they might pass away on the IRA, to what the tax would be with the distribution solution. So in this case, looking at age 90, $1,355,000 versus $384,000. He will put this chart in front of the client and say, this is going to save you $1 million in taxes. You need to do this. And who's
going to say no to that?
Well, yeah, and it's become a joke. We call this the okay sale, because I mean, literally, he doesn't even use the rest of the presentation. He puts that in front of their clients, and that's what he says, and they go, okay.
I love it. I love it.
I mean, it's hard to argue against paying another $1 million in taxes.
Yes, no, exactly. And the only caveat is the insured or the prospect, must be insurable, obviously. But this is the no-brainer, and this is just the opener. So, okay, I'll let you now explain how it's all done, Mary, because everybody, I'm sure, is scratching their head now. They want to know, okay, this sounds great. So, what's what does the policy and the premium look like?
All right, so let me explain how this works. And then we'll talk about the benefit side of the equation too. But actually, before I even get into the details, let me just set the stage. We know we have tax savings, but have we lost benefits? That's the other half of the equation, right? If we got tax savings, but we're losing benefits, maybe we're not ahead. If I take that same 55-year-old example, right, with $1 million, if I compare the benefits through those scenarios with the IRA, same assumptions, right? Taking the RMDs, if I add up the net after-tax amount of the RMDs plus the net after-tax amount that the beneficiary will keep, the total benefits on that account are $1,031,000. Okay. So we started with $1 million, we paid $1.3 million in taxes, and we got a little over $1 million in benefits at age 90. If we did the Roth conversion, we boosted up the benefits, right? We got the tax bill down to $514. The benefits paid out after tax in total $1,867,000. That's better than the traditional for this person. But if we did the life insurance that we're talking about here, the death benefit, if they only used it for death benefit, that would go to their beneficiary is $3.3 million income tax free. If they wanted to use it for income, we ran this illustration maximizing income as loans, not using the guaranteed lifetime income rider, which is a whole nother option here, but just taking loans. We're taking $93,000 a year out of this policy starting at age 65 every year to age 100. Total proceeds, if this person died at 90, under that scenario, they would have taken that much cash, and then the remaining death benefit goes to their beneficiary, is just under $2.8 million.
Unreal.
So I know that's a lot of numbers, but on the tax side, we went from a traditional tax bill of $1.3 million down to $384,000. On the benefit side, we went from benefits of $1 million up to either 2.8 or 3.3.
Unbelievable.
And that's only the beginning. Because it can get, that's the plain vanilla version, and then we can get much more creative and make those benefits even greater.
And we have some living benefits included in there too, right?
Granted, there are living benefits on this policy, so they're getting multiple protections here. We're lowering the tax bill. We're increasing the benefits, whether it's for cash use during their lifetime or pure death benefit to their beneficiary, or the combination. The policy has the living benefits. In this case, this policy would be at the maximum under, that are allowable. So $1 million for critical, 1.5 for the $30,000 per month for chronic, tax-free benefits, which they would not have if they left the money in the IRA. So if they became ill and needed some kind of long-term care, if they had to pull that money out of the IRA, they're just going to deplete that account that much more quickly. Or they'd have to buy a long-term care policy, perhaps, for the protection, whereas here it's all wrapped into the life insurance policy. And if they never use those benefits, fine. The benefit will go to their beneficiary's death benefit.
No-brainer.
Yep.
I love it.
So,
yeah, they're going to say
right?
what? So what's the downside? It's like too good to be true. I'm sure that's going to come up.
Okay, it does sometimes. So let's talk about the good and the bad. So let's talk about the structure first, so we can get into the details a little bit. What we're doing here is first of all, where does this begin? This begins with someone who has this pot of qualified money, right? This is not about accumulating the money. I can help people do that too, but this strategy is for people who've already done that. So they have this pot of money sitting somewhere in a qualified account. It might be in an IRA, a 401k, a 403b account, a defined benefit plan, a SEP plan, a simple plan, any kind of qualified account. They've already created a tax problem for themselves, right? If they have $1 million sitting in that account, whenever it comes out, they already have a tax lien sitting there. With my assumptions that I was using here in my little example with the maximum federal and that about 5% state, they've got a tax bill waiting out there, about $455,000? It's about $422,000, I think. Which means even though their statement says $1 million, they really only own about $577,000. So they already have the problem. So they're our candidate. So how are we going to solve that problem? Under the tax rules, right, whenever you take $1 out of a qualified account, you pay tax on $1. Doesn't matter what it was invested in, you pay tax on $1. There is one exception to that rule, and only one. And that exception is that if that dollar is sitting inside a life insurance policy, and we distribute the life insurance policy, you're taxed on the market value of that policy, not the dollars you put in. Now, this is defined by an IRS revenue procedure, IRS Rev Proc 2005-25. That came out in 2005. Some people on here may remember springing cash value policies back in the 90s and early 2000s. This revenue procedure was to shut them down, and they did a very good job of that. They did shut them down. So what this revenue procedure specifies is that when you distribute a life insurance policy from any qualified plan, it's taxed on its market value. And then they define market value. Market value is not the same definition as cash surrender value. They define it as premium paid plus earnings minus the reasonable charges. And they go on to explain exactly what those charges are. They have to be the actual charges. You can't manipulate the numbers. So where does that get us? If you have a life insurance policy where that market value will be lower than the premiums you put in, you just got some tax arbitrage. Now, in that revenue procedure, they include a safe harbor calculation for that market value. They leave room that you could get an appraiser, and you can, and if you do, they can challenge it, though, and you might win, you might lose, but you might end up in court. They included a safe harbor calculation. So what safe harbor means is they can't challenge it. It's their calculation. So that's what we use here. And so the trick here is to find a policy where we'll pay the premiums. Now, we're going to buy this life insurance policy inside a qualified plan. So for this person who has this qualified account, we can't buy life insurance in an IRA. Not allowed to. So we need to move that money. We'll do a rollover or a direct trustee-to-trustee transfer into a 401k or a profit-sharing plan. If they don't have one, we will create it. That's an easy thing to do. They need to have some earned income for us to be able to do that. They have to have active income. So some people already do. They own a business. That's easy. If they have an existing 401k plan, we can just amend it to add the language for the life insurance if they don't already have that. Or we can create a 401k plan. Or if someone doesn't have a company, the question is, can they generate $5,000 worth of earned income on a Schedule C, 1099 income? And people can get very creative. We've had people get very creative about doing that. It's not a lot. We just need enough to make it reasonable that we'll then set up a little solo K plan for them. We'll roll their money into that solo K, and inside that solo K, we buy the insurance. So it's all pre-tax money, no tax so far. We buy the insurance with the pre-tax dollars. When we're using the Index Universal Life, we do it over 5 years. So we will pay for that premium over 5 years. In my example here, if we were doing $1 million, we would do a $200,000 premium a year. At the end of the 5 years, that policy is fully paid for. And so now we will distribute it out of that 401k plan to that individual. We change the ownership from the 401k to that person. That triggers taxation, right? Remember, we're not doing tax evasion here. We're not going to jail. So this triggers taxation. We have to write a check, but it will be a smaller check. So to go back to the numbers again, right? If I left that $1 million in the account and I grew it over the 5 years, at the end of 5 years with my 4% assumption here, it would grow to $1,216,000. If I took all that cash out, let's say I did a Roth Conversion, my tax bill would be $514,000. But instead, by putting it into the life insurance policy, when I distribute the policy under this IRS calculation, the taxable value of that policy is $908,000. I put in $1 million. The tax value is $908,000, so that brings my tax bill down to $384,005. And so I just eliminated $130,000 of tax on this asset. And I've now repositioned and now all the money is repositioned, so everything after that will be tax-free, whether they want to pull cash out of the contract as loans, whether they want the death benefit to go to their beneficiary. No more RMDs because it's not in the qualified account anymore, and they've added the living benefit.
And I feel like, Mary, if an agent can get their arms around this concept, and many of our agents are doing this right now, but I feel like if you can get comfortable with this and explain it properly to the right prospect, it's a no-brainer for you, for the client. It's a win-win. So I don't know. I love this strategy, and there's no small print. There's nothing there. It's everything to gain. So I love this, Mary.
It's very clean, and the conversation, to open a conversation with a client, is really, it can be very simple. Do you have money sitting in an IRA or a 401k or some qualified account? Most people will, right? How much money do you have sitting there? That's a pretty straightforward answer. Now, if they say I have $200,000 and I need that money in a few years when I'm going to retire, they are not a candidate. But if they say I have $500,000 or $1 million or $2 million or $3 million, then the question is, what do you plan to do with that money? And if their answer is something like, I have other money, I'm going to spend down my non-qualified assets first because I don't want to pay the tax to take it out, which is a common answer. So I'm going to let it keep growing. And in fact, I think I'm never going to need that money. I expect I'm never really, I know I'm going to have to take my required minimum distributions, but I don't really expect to really need this money. It doesn't mean they don't care about it, but they don't need it. So then the next question is, what is your plan for getting the money out of those accounts? Nobody has a plan. You will get silence. Nobody has a plan. We have a plan that can help you move that money out, get the tax exposure down on that money, and increase the benefit that will go to your beneficiaries. Would you be interested in looking at that?
I love it. Love it. So Mary, if you put your agent hat on, right, and you're on this call right now, listening in, you're writing down some notes. So who would your target audience be? Obviously, white collar professionals. What kind of tips can you share with everyone on the call like that? Who they should go look for and share the strategy with?
We're looking for anybody who has, if they have a qualified account, typically these accounts are $1 million or more. Could be as low, $500,000 would be on the low end. Okay. So people who have a qualified account or a combination of accounts that would be $1 million or more would be the primary target. Those may be white-collar workers, but they could also be, there are a lot of business owners who drive around in pickup trucks who make a lot of money.
Oh, yeah. Oh, yeah.
Right? So don't overlook those people. Some of the large accounts I've done have been people like that. So do they have money? So we're looking for people with money in those accounts. Age-wise, the sweet spot is somebody between 55 and 70. 55, so that when we distribute this policy in 5 years, they'll be over 59 and a half, and we will not have a 10% penalty. If we can get them before they're 67, right? We could get this done before their RMDs hit. That being said, I do a lot of people in their 70s. I think because at that point they're realizing they either do or don't need this money. They feel more comfortable with that. And also they're being hit with the RMDs. And as I said, people hate the RMDs and they want to find a way out from under. Now, when we get, and I'll just add here, I want to talk about the older people for a minute, but on the young end, the youngest person I've done is 35. The oldest person I've done is 88. That's a pretty big range.
That's a huge range. Tell everyone what the average target premium was roughly for last year.
Last year, my average target premium was $175,000.
Yeah. So just keep that in the back of your mind too. These are nice cases. Okay. So 55 to 70 on the average, and then what you said, 35 to 88. Roughly is a good range.
Yeah. And the reason we can have such a range is there's quite a bit of flexibility here. So let's talk about the 35-year-old for a second. So this was a 35-year-old. He makes $5 million a year. He does something on the web. I don't know what. So he makes all this money. He already had accumulated $250,000 in a 401k plan for himself. He knows, right, as long as it keeps growing, he wants to keep contributing to the plan. He will keep contributing. But he knows as long as that money grows, what are the tax rates going to be by the time he's 50, 60? Probably not low, right? So what he did was we did this strategy, right? We used the IUL, paying for it for over 5 years. Now, when we distribute the policy to him, it will have a 10% penalty because he's only 35 now. That was inconsequential because he's so young. It buys so much benefit. And that policy will have so many years to grow that 10% was a non-event. He is laddering these strategies. He's doing a new one every 5 years. So as he contributes to his plan, he builds up another $250,000. He does another one, and he keeps contributing. His plan is to keep doing that.
Unreal.
Now, at the other end of the spectrum, when we get to my 88-year-old, right, as we get into the older ages, we start to run into a couple of issues. Number one, just because someone is older, the insurance is going to be more expensive. Well, just a factor of age. This is what it is. And we also tend to run into more health issues that can get in the way of underwriting. So in this strategy, and our 88-year-old was actually too old to issue the insurance too. But in this strategy, the rules for buying this insurance, remember, in a 401k or a profit sharing plan, the rules in those plans allow the owner of the account to use the money in their account to buy insurance on themselves or anyone they have an insurable interest in. So they can use that money to buy insurance on their spouse, on their children, on their business partner. I've yet to have anybody use their business partner, but they could. We do quite a few of these where we divide the money between the owner of the account and their spouse, so they both have the living benefit. But we also do a lot of children. Now, if we do children, now we're talking about a legacy and a wealth creation plan for multiple generations.
Which is a whole nother marketing angle now, too.
Yes, this is a whole nother world.
Yep,
so,
that's right. That's right.
So, for example, I did a case a few months ago. I have 3 siblings who own a business. They're very successful. The business is 5th generation. So this business has been around for a long time, and it's likely to stay around. Very successful business. They've been putting money away in a 401k. They're older. Their grown children are now in the business with them. So they wanted to do something with the money and they have in their 401k. They realized they're in California too, which just makes the tax problem that much worse. Their tax rate is combined state and federal is about 57%. So, so they wanted to do something. So they wanted to do this strategy, but they said, we don't need the money. We don't need the money. Our kids don't need the money. They're already rich. So what they did was they took their money in the 401k, used it in this strategy, but instead of insuring themselves, we insured their children. So it buys a much greater benefit because their children are younger. Now the parents will own these policies until they pass away, which means they have full access to the cash in the policies should they ever need it. They can pull it out tax-free with loans. At their death, ownership of the policy will go to their children, who are the actual insureds. The children now have this death benefit on their lives. They'll own the policies. They have access to all the cash in the policies tax-free over their lifetime if they want to use it. And ultimately, when they pass away, the death benefit, which we just created, will go to the grandchildren income tax-free. So we created a wealth transfer. Now, I'm going to give you some numbers. This is a different case. This is another one. I just presented this one to the client a week and a half ago. This person has 4 children, so we divided the account. So this is just a $300,000 account because we divided his money between his 4 children. So I'm just looking at one here. The owner here is 64, and the child is 27. So if I let that $300,000 in the IRA and let it grow at my 4%, and we get to, the owner is age 72, they'll have to take their required minimum distributions. And I presume in my estimate here, and I'm not trying to kill him off, but I presume he dies at age 85. When he dies at age 85, what's left of the account goes to this child who's now 27, goes to this child. He keeps it in the IRA, the inherited IRA, for 10 years, and then he has to take it out. Okay. With all those assumptions, starting at $300,000, the child will eventually inherit after taxes $417,000. The parent would have taken some required minimum distributions. If we add all that together, total paid between the $417,000 that will end up going to the child, and what the parent receives, the child paid just under $600,000, all total. If instead we take that $300,000 and we buy the insurance on the child here who's 27, it buys them $2,850,000 of death benefit. All right. Now we get the tax bill down. We get the tax savings. I don't have those numbers in front of me, but we get the tax bill down. So now we have this $2,850,000 benefit on the child. Right? If we go to the same year, if we assume, the parent dies at age 85 and that IRA would have been paid out after 10 years and the child would have netted after tax $417,000 from that IRA. If I look at the life insurance policy in the same year, we know the death benefit on that child's life is $2.8 million, but the cash value alone in that policy in that same year is $1,081,000. So
unreal.
Rather than inheriting $417,000, they have inherited this policy with a little over $1 million of tax-free cash available to them.
Yep, it's creating a legacy. I love it.
Right, and if they don't use the money or whatever money they don't use, we've got this $2.8 million. Now that may go down if they start to draw money out of the contract. That will be their choice. If not, that's going to go to their child. And if they live to age 85, I have the number in front of me. If they live to 85, their child's going to get over $6 million.
Unreal. See, I feel like it's just getting a little creative with the same products that we're selling every day. It's like just putting a little different spin on it, and it changes the world for an agent prospecting. It's great. You know what else just came to my mind, Mary, and I'm sure this comes across your desk all the time, but imagine how many CPAs, estate planning attorneys are out there that have no idea about this, and how, if that agent can bring this to the table and introduce this and work with a CPA with their clients, that could be huge. I'm sure this comes up a lot.
Yes, it does. It can be huge. And the CPAs do not know about this strategy. Most financial advisors do not know about this strategy. Most estate planning attorneys do not know about this strategy. Once they learn about it, the CPAs love it. They just need to understand, they want to understand how we're doing it, and they want to be sure that we're not putting their client at risk. When they understand we're using the IRS regulations and we're staying in the safe harbor, then they're very comfortable with it. The estate planning attorneys love it once they understand what we're doing. We've had several of them get on board. The key is just to get in front of them so we can explain it, and once they get it, they really like it. The big question that comes up is, if it's so great, why haven't I seen it before?
Oh, yeah. I can only imagine.
We do get asked that. And the reason they haven't seen it before is you need the right product to make this work. I have looked at hundreds of products. I have 2 products that work. So we need the product to do some very specific things. We want to be able to put a lot of cash in up front without mecking the policy, although sometimes we go to a one-pay and even mech the policy if we're doing an estate plan and it doesn't matter. But typically speaking, we want to be able to load a lot of cash into the front of this policy without mecking it. We're going to take it right up to the mech limit, but we don't want to mech it. We need to pay for the policy in this short period of time. We want a horizon of 5, no more than 7 years. We need the attractive perk value, that taxable value when we distribute the policy has to be in our favor or we can't use the policy. We need an insurance company that will stand behind its perk value and support it. I have gone to some companies who they would not. If they won't, I won't use their product. Some of the companies have features in their products that don't comply with the perks, so then I can't use those. I see a lot of products where we ran the numbers, but we had a catastrophic drop in death benefit after year 8 because of the mech issues. I'm not going to use that. I don't think that's an attractive option to a client. So there are a lot of things we look at to make a product work here. And the companies that don't have products that work have no reason to talk about the strategy because their product doesn't shine. in it. And so you can imagine if I've looked at all these products, and I've been doing this for a very, very long time. I've been looking into this strategy for, I don't know, maybe 17 years. I mean, it's been a long time.
Mary, I want to mention
I've only have two products.
Let me mention one thing to everyone real quick. I want everyone to understand that Mary does not work for any specific life insurance company. She is not an employee of an insurance company. So it's not like she has skin in the game if you sell a certain carrier or product. So this is very important, and you need to make sure your pen and paper is out right now because she's going to share the products that work best. So, okay, Mary, I didn't mean to interrupt you there.
No, but thank you for making that clear. I am completely independent, and I've had many people bring me products. I have one sitting in my inbox right now. Because they like certain companies and want me to look at those products, and I will always look. And so that's why I have looked at so many products, because I want to use the product that works best for the client. So with all the searching I've done, the products that I have right now that work the best, that are the products that I use for the Index Universal Life, it is National Life. It'll be Life of the Southwest. Most of the time, the same company, right? Just one subsidiary, which paper it's on. But it will be the Life of the Southwest National Life product. I can tell you, if you know those products, we're usually using Peak Life, sometimes Flex, depends on the age of the insured. For the whole life option, because sometimes we have someone who would prefer whole life because they want no risk, right? We didn't talk about risk yet, but we will. Risk is a big part of this. For whole life, we use Lafayette Life. We have found their product to be the best for the whole life option. Those are my two products. So and I'm sorry to National Life that their whole life didn't work as well. Sorry. Lafayette works really well.
We have both.
We
so
tried.
Okay.
We tried, but we couldn't get it. So let's just talk about risk for a minute. What risk is there here? We know if they stay in an IRA, whether it be if they stay in the traditional or the Roth and they want to grow that money, they're going to have to be in the market, right? I mean, just in a traditional IRA alone, when you get to having to take your R&Ds, it's a climbing percentage of your account. It starts at 3.91%. It keeps climbing. So if you don't want to eat away your principal, you've got to be earning a greater return than that to keep your principal whole, which ultimately is going to push you into the stock market. If you've converted to a Roth, and again, I mean, if you don't want the account to grow, fine, you don't have to. But if you want that account to grow, you're probably going to end up in the stock market. And once you're in the stock market, you have risk. You have a tremendous amount of risk. And as you get older, that risk, the sequence of returns really can become a problem. As part of my presentation, I have the history of the S&P 500. When the market goes down, it does come back. But if you look at the time frames for it to come back, it can be pretty daunting. If I bring that chart up, I'll put it in front of me so I can quote you those years. We're looking at the last time it took a big drop, it took 14 years to get back to break even. Before that, 23 years. Before that, 29 years. Before that, 26 years. So if you're 65 or 70 or 75, you don't have 20 years to wait for it to recover. And that's just to recover, not to earn money. And if you add to that, you have to take your required minimum distributions while that's happening, you're just never going to recover. And is that really a risk that people can sleep with at night as they get older? When we go to the insurance, when we go to the Index Universal Life, we eliminate that downside market risk. We eliminate it because the policy has a floor of 0. Now, it's not no risk, and we'll tell people it's not no risk, right? Because you want the S&P to earn positive, so you're getting those positive returns in the policy. The insurance company protects you on the downside with the 0, but they also protect themselves on the upside with the cap. But you want those positive returns because we all know, even with the floor of 0, if it were actually to stay at 0 for an extended period of time, the insurance expenses inside the policy would be eating away at the value. So we're hoping, we get those nice returns on the S&P in that narrow corridor to protect us, and we'll get nice growth. And that's perfectly good. And lots of clients like that. But if we have a client who wants no risk, they're, for whatever reason, really antsy about the market and they want no risk, we have this whole life option where we can go into the whole life policy and have no market risk. So depending on what's important to the client, what meets their needs the best, we can go, the appropriate direction, hopefully to satisfy that for them.
I think, and with Lafayette, obviously the whole life has the guarantees. The IUL has the 0% floor. It's like the old zero is your hero, right? So I think in both cases it works depending on the client's situation, just like what you said. So
yes.
We have a perfect scenario for either or.
Yes, and both policies, by the way, do have living benefits. They're a little different. National Life for Lafayette, but they both do have living benefits built into them as well, which is a very good thing, in my opinion. I think those are important benefits for people.
Me too. The new kind of insurance. I love it.
Yep. Yes, it's great. It's a great advancement in insurance.
Yep. Okay, good stuff. So, is there so we have the two options here, and then, like I said in the beginning too, you have that 1-year tuition scholarship that comes with both of these products that Mary just touched on. So that's another added value that, in fact, she didn't even bring up, but you can think about all of the pluses that she went over, and then you can also bring up that scholarship program, which doesn't cost them anything. So that to me is the ultimate. Okay. Is there anything else, Mary, you want to touch on before we wrap it up?
I think just one little thing, I think, just to kind of bring our heads back together here.
Of course. Let's do it.
Right. So just a couple little things to that. This all starts with a tax conversation. That's where it always starts. You have this money. If you thought about how you're going to get it out, you have this tax bill coming your way, and we can help with that. This is complex, but we don't, we want to protect against getting lost in all the details. That's my job, to know all that, and to be able to explain it in a way that the client understands, which is, a lot of what we did today. Obviously, we'd have visuals for the client and everything to help them follow along. The concept is not complicated, and it doesn't intrude on their cash flow, right? Because we're working with money they already have. So this has no effect on their day-to-day cash flow needs. This is just a repositioning of an asset they have that's highly taxable to put it in a better tax advantage place. And that's a valuable thing to bring to people.
It's brilliant. And think about all of the opportunities, the networking opportunities. And, I think it's so important, and I want everyone to jot this down. I said it in the beginning. I'll say it one more time. If you want to write down these 7 bullets, it's basically a tool for wealth creation, a tax strategy, a way to reduce taxes, right? Tax savings, a legacy creator, peace of mind for your clients, a way to reduce risk, your legacy on your terms. I think that's the ultimate door opener, right? So anyway, I want to just end with a couple things. Number one, what we will do is when you get appointed, if you're not already appointed under us, with your first app, we will mail you any one of Mary's 3 books. I believe we have 2 different versions, and then we can always get the third, but they are incredible, and she's a wealth of knowledge, as you just witnessed. I learned a lot myself. I thought that was excellent. And I also want to add that, yes, there's a few moving parts, and you can keep this very simple, like Mary discussed, or you can make it complicated. And if you need to leverage Mary, right, if you want to get her involved, she is open to working with you if you have obviously the right client and it's the right relationship. You just let us know, and we would be more than happy to make the introduction, and she can work with you on this. And, I think at the end of the day, this isn't going to replace your day-to-day sales. You're going to keep doing what you're doing. But if you have the right clients, especially in your existing book or network, this is a no-brainer, especially working with Mary, right, to put the icing on the cake, help you make the presentation. And the average target is almost $200,000. So these are nice cases and a nice way to supplement your income and, most important, help your clients. And I love the angle in working with CPAs and estate planning attorneys, bringing up this strategy because most of them have no idea about this. And just like she said, they're going to say, oh, this is too good to be true. How come I never heard about it? Well, she just told you exactly that. So anyway, I hope you listen to this over and over. Reach out to us anytime. We are here to help you. We can run these illustrations. We'll get Mary involved if needed. Mary, I really want to thank you so much for your time. You were so generous with us today and for our agents. I so appreciate that. So thank you for that, Mary.
Thank you. Thanks for having me on.
Of course. Okay. All right. Well, I wish everyone lots of luck, and I hope everyone stays safe and things start to get better during this COVID-19 pandemic. But here's another feather in your cap and another good sales story for you to talk about. With that said, thank you for your time. We're going to put a ribbon on this. The recorded version will be available on our website, all of our podcast channels. I hope this was worth your time. Have a great rest of the month, great selling, and thank you again.
Thank you for joining us for the Bill Levinson Experience. Please feel free to share this podcast with anyone you think would be interested. You may also visit levinsonandassociates.com and all of Bill Levinson's social media pages for more information.